Most traders who bought Bitcoin's breakouts have put their stops in the same place. Half the range heights, the one level everybody with real money can already see. Here's how to trade the side that will get you paid. So who gets paid when you're stopped out? That's the big question. Somebody is, and today it's worth knowing that it shouldn't be you. So by the end of this, you'll be able to do three things. You'll be able to spot a failed continuation at a range high before you chase it, work out where the crowd has picked its stops and why they will always land in the same place, and how to enter after the stop run instead of being the stop run. So, quick look at the overview before we get into that. The shenanigans continue. The breakout, again, we are seeing an attempted breakout on the main stock indexes on SPX, on the NASDAQ. Slightly smaller range on the Dow, but we can see these inside bars, inside days, is really what we're looking at. And again, we've seen the highs breached first, and as we know, that's usually a false direction. We've seen this a few times. You commented it this week and last week, and the Russell's just not participating. Most of the moves pretty much on the back of four of the biggest earnings in the across the indexes. So we are seeing a little bit of lift overnight. I would imagine we're going to see that reverse when the market opens. So strap in, we're going to dive a little bit deeper, and I did this yesterday in one of my mentorship calls. A new high was basically attempted, and if you remember, just off to the left here, we've got back to back monumental gains from the range lows to the range highs. And essentially after that, and we've had a little bit of fun trading these inside bars from the false breakouts, what we should see is, because we got that push higher, retracements, we're looking at that pullback for a continuation, but then we get this exhaustion bar, is how I phrased it. It's sometimes known as a Pinocchio type bar. It's essentially an inverted hammer, is another way of thinking about it. Basically, it's got a small body and a really long wick. Now, individually named candle patterns like this happen all the time, but they don't mean anything without context. But it does make me sit up and pay a bit more attention to that context and update my analysis. So prior to the vertical move high, we pulled back and set up the inside bar that we've already traded, and basically that was a quick scalp. And that should have led to continuation high. So if there's genuine buying there, we'll see that follow through move. But it didn't. And that's when the Pinocchio bar was created. A failed continuation is a possible reversal at this stage. Now, zooming out, this is where the point and figure charts really come into their own. Prices at a previous stopping points. We can see that price pushed through this level on the chart, tried to rally back, and then we saw the big sell-off. Grinded higher for several weeks there, back up to the same point, and then we saw the big sell-off. So we're seeing a huge selling pressure at this approximately 80,000 zone. So even though we are again seeing these smaller consolidations building this bigger picture up, is this a larger consolidation pattern that we're having to consider? So right now we're back at that resistance high. So again, the possibility of a new larger range is on the table. So this is the third time that it's basically been here, and this time it's failed to move any higher. So we've got multiple points already for the consolidation low. I've got 3 points, and the third one is the question mark in fairness. So the context is building. Price is at a range high with a failure at this stage to break up and out and continue that trending move. So where is a stop going to be? The people who traded, firstly, the pullback continuation, the people who traded this consolidation, pretty standard stuff is to place a buyer above, a sell order below, close your eyes, hope for the best. And then whichever side breaks first, so we could argue that this is the side that's broken, if you like, or attempted to move higher. All those FOMO traders, all the people who are trading the pullbacks, the continuation, the range type traders, they're all trying to join the party. So where are they going to place their stops? Usually we'll take the height of the pattern. With whatever we're looking at, this is a general good rule of thumb, height of the pattern, and just mark off the 50% level. And similarly, those people who did actually get in from the range lows here, and traded that up, they're going to do the same thing. They're going to lock that profit in. They're going to lock half the profit in if they're reasonably sensible. But this then acts as a magnet for price to move towards that stop run, the liquidity grab. And I've heard lots of similarly phrased money, but the reality is there's nothing really special or practical about these. This is just those common traits, common habits that we as traders tend to take. I'm missing a move and want to give it some wiggle room. I want to get in the move and trade the range, bracket it, move your stop loss. I'm already in the trade. I want to cover half my position, blah, blah, blah. All these standard practices. And again, it acts as a magnet. So if this is going to be a failed move higher, and are we going to see price push lower to around that 70,000 mark? So the pin bar also gets the same treatments. Now, when we look at the pin bars in just a second, they'll use the height of that pin bar, the height of that hammer bar, to determine a target, for example. So to artificially get this 2-to-1 risk-reward ratio that somehow is the minimum magical number, because they know the height of the pattern or the range, the consolidation, and we're also looking at the hammer bar. The height of that pattern that's getting you in the trade is typically used as a target. So because that is 100% of your expectation, a lot of people want 2-to-1 reward to risk. So they'll halve that and place their stop there. So again, case of the range, height of the range is the target. So half that will give them that, risking 1 to make 2 phenomenon as an absolute minimum. Again, the same is true when we look at the Pinocchio bar. A little bit of a sidebar. Martin Pring named the Pinocchio bar in the first place, named the anatomy with it, and there's a whole subculture around that particular pattern. So the Pinocchio bar, so we've got the pin bar over here on the daily charts. What a lot of people will do is they'll, again, on the trigger of that low, so that little push down here, these little pushes lower, they're breaking the low of that daily pin bar. So again, because the dumb money is essentially always FOMOing, they're always fearful of missing out. They want to get in as early as possible and have the tightest stop loss possible. So where are they going to place their stop loss? They're going to use the low of that pin bar, get in the trade. They're going to place their stops at half the range and, hope for the best, basically. And we did this last week when we looked at the same type of phenomenon around the inside bars. Beside the bar breaks is usually false breakout. Again, think about an inside bar like a consolidation, like you just described. Buy it above, sell it below, close your eyes, hope for the best. Whichever side the bar breaks is kind of like a stop run, is how I've always phrased it, or a liquidity grab, or a sweep, or whatever other bullshit the internet gurus are talking about these days. But the reality is all the institutional traders or the big traders are looking for is a means to fulfill their own order book. Because we're talking about hundreds of millions of dollars here, so collectively, all our little retail trader orders kind of add up and allow the people who can move and influence the market to move and influence the market, push it around and try and kind of gobble all those orders up. So anyway, the pin bar phenomenon, low of that range is break, and all I've done is used the bar to the left of the pin bar, which is what that red line is there. That is my kind of minimum expectation. Stops might go past there, or 50% of the height of that pin bar, as mentioned on the daily chart. So this is basically what gives me that zone. So we'd anticipate price to get the bear traders in, stop them out, and then continue down. So we've got multiple layers of false breaks and stop runnings going on at this level. So as we said, if the bull break or the continuation pattern, again, this huge move higher, all the FOMO traders are going to rally higher. They're going to get the bullish trade here, which is what created the Pinocchio bar. There was only retail traders on it, hence it reversed price activity. Where are their stops going to be? Their stops going to be below the lows, which is where the cursor is, which is that prior attempt at the inside low breakout. So I've got my trade on here. My first decision point is going to be about 76,000, and that's where I can assess. And if there is going to be some genuine selling, further genuine further selling, we should then see a fast move down to about the 7100, which is that 50% the height of the range that we're evaluating. So we've got two possible target zones here. A small one, which we could probably after the fact say a little bit of a scalp, and if we get some follow through, we could see the move down to 7100, and then we're back to assessing, is this going to be a great location to be a buyer for what could be the genuine breakout move? Time will always tell, and we'll evaluate along the way in real time. So there you have it. The pattern plus context is the higher probability trade, and the framework that I'm using really revolves around my 6 money making patterns: buy the dip, sell the rally, break of range highs, break of range lows, reverses off range lows, reverses off range highs. And what we're talking about is that hybrid in between the range type trading, where you attempt a breakout and then it reverses back in, kind of like that failed breakout. That failed breakout, that failed continuation, is the range reversal unfolding essentially. It's moving back in or moving away from an assessment. So although I have these 6 money making patterns, that logic can be applied to pretty much any pattern that you prefer to choose, whether it's just standard support and resistance trading, Fibonacci, Gantt, Elliott, yada yada, all the other kind of analysis methods that you want. But behind it all, for me, is 6 money making patterns. So that's it. A pattern plus context equals a higher probability trade. Now, quick look at SPX, because again, we've got something very similar going on here. We already know that the S&P, this is the cash, the S&P has been in this consolidation. A little bit of news is going to pop the price about 30-40 points higher as I'm recording this. But we've got that same problem. What we'd want to see is price to retrace and then continue, just like we've been looking at on Bitcoin charts. But if it doesn't, then what we're going to see is that gap higher, trade low. We actually saw this yesterday on Meta, huge gap higher on some news, and then traded low because nothing really fundamentally is changing. Same here, we've got a little bit of overnight excitement. We're probably going to gap higher, and then likely we'll see that trading lower. Also, a little bit of sidebar, 3 days to go, and we are officially in bear season. September, October is that bear seasonal cycle. I was kind of hoping it would come a little bit early, but as we grind, I can't believe it, we've grinded through August, and we've gone to September. Again, I'm going to be talking bearish, non-stop until it happens. But that's just my own personal preference. Anyway, we've got data to support it. It's seasonal, it's cyclical, it's anticipated. It typically happens about once a year, September, October, or February, March. And I try to make all my decisions based around data and historical patterns repeating themselves, because what that means is that less brain, so I'm not trying to make it up as I go along, less brain equals more gain. Because I am not smarter than the data, whether it's a liquidity sweep or some other made-up acronym that explains any of this. You need to know where everyone has their stops. In this case, these are the common places, because that's what textbooks tell people to put their stops. So I want to try and exploit it on this occasion, and then follow the data, follow the system, follow the process. And if you want to learn more about how to collect morning income or weekly income, like how I show you, and it's applicable to any chart, any markets, as we're proving, come along and see how we're doing it. Check out the link in the description, or go to antiinvestor.com. With that said, I'll see you on the next installment next time, probably tomorrow. Bye for now.